Hello, everybody. My name is Anthony Vokes, and I'm a tax director with Right Vigar. And I'm going to talk to you today about the recent changes to pensions tax in the budget. I think it's fair to say there were some very consequential changes for many clients. Historically, pensions have been a very tax efficient tool for estate planning, given that they were generally written in trust and could pass to the next generation with no inheritance tax at all. Well, that's all going to change. So what I'm going to do is I'm going to talk you through some of the changes. So just to sort of recap what the rules currently are, because the changes don't actually come in until 2027, but just to recap where we are at the moment. So pensions would generally be written into trust for the next generation, so they could generally be passed with no inheritance tax at all. And better than that, there were further benefits if you were to pass away before age 75. I think death is probably slightly drastic tax planning, but if you were to pass away before age 75, the pension could often be inherited by the next generation with no tax at all. So no inheritance tax and also no income tax when drawing the pension down. So very tax efficient indeed. If you pass away above age 75, then still no inheritance tax, so efficient from that point of view. But generally there was then income tax on the drawdown by beneficiaries going forward. So not quite so good, but still relatively tax efficient. So for quite a number of years now, the tax efficiency of pensions has encouraged people to actually retain their pensions, hold on to them for dear life, because they knew that would be a tax efficient item to move down to the next generation, free of IHT. So people have been encouraged to spend other sources of wealth, so ISAs, cash, that they would go ahead and spend those, but try and keep their pensions as much as possible. But I think that's going to change. So with effect from April 27, as I mentioned, pensions will no longer be free from IHT, so they'll now form part of your estate for inheritance tax purposes. The age 75 rule will still apply. So if you're lucky enough to live beyond the age of 75, there would be both inheritance tax on that estate, on that pension, but also income tax. So it's effectively double taxation, which could result in an overall tax rate of up to 67%. So I mean that is an incredible change from where we were. A very significant tax bill. Even worse potentially. So there is currently a residence nil rate band available, which gives an additional £175,000 per couple of inheritance tax relief for passing down the main residence. This is where, in theory, a couple could get £1 million allowance from inheritance tax by combining their nil rate band of 325,000 and also their residence nil rate band of 175,000 each. But that is actually incrementally lost where assets are in excess of 2 million. So if you start combining your pension, many people have got quite substantial pensions. If you start combining your pension assets with your other assets, your house, your cash, your stocks, your shares, and it goes over 2 million, then you will start to lose that residence nil rate band. And the result of that is that the inheritance tax rate on assets between 2 million and 2.35 million is not actually 40%, it's actually 60%. That's because you pay 40% inheritance tax, but also you lose your residence nil rate band, and that equates to an effective tax rate of 60%. So that could affect quite a number of people. What I would say is that this applies to most pension schemes, but not final salary and defined benefit schemes. So these are schemes that are often used by the NHS and police and firemen and people like that. So a final salary scheme, they're generally very generous pensions, but they don't generally have a transfer value, so that they're probably going to be less affected. But what it will affect is people with SIPs and SASAs and any other pensions, general pensions. So they will be affected, but not generally people with final salary or defined benefit schemes. So just to summarise, the new rules come in from April 2027, and they are the biggest tax changed the pensions that I can remember in my my long career in tax. So it's a very significant and wide-ranging changes. So it is going to be really imperative that people take advice on whether on how they can mitigate their overall inheritance tax position, because you don't just need to really consider the pension position. You need to consider the position in its overall generality. So I think that's going to need a good look. And many people will now question whether it's worthwhile to keep pensions anymore. As I said previously, it was people did try and keep hold of their pensions as much as possible because they knew there would be a tax efficient succession to the next generation. But now I think spending the pension fund may become much more common, because if you're faced with a tax bill of potentially, up to 67%, then it makes sense to maybe spend the pension fund going forward. And I think there'll be a lot of people who are looking at this carefully between now and April 27. So anyway, that was just a brief update on where we are with pensions. If you've got any queries, then please do come back to me or speak to your normal Right Vigo contact. Thank you.